All right. Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Eddie. He's a first generation immigrant, embodies the values of perseverance and commitment while a background in real estate and tech consulting. He's skilled in sales, training, and data analysis, holding degrees in management information systems from University of Illinois at Chicago. Eddie, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yes, definitely. Appreciate the opportunity to be here, Josh. A little bit about me, born and raised in Chicago. And I always tell people when they ask me about my journey in real estate that I was just kind of born into it. Since I was young, my father would invest in single family, smaller multi-family. I'd grow up helping him out, put up some drywall, plumbing, right? So that's what I did on the weekends. It doesn't
Oh, yeah.
sound as exciting, but I got to understand the power of real estate throughout those years.
Yep, that gets you in there in the thick of it, and those are skill sets that are invaluable for years to come. It's and it allows you to be humble. So if you're helping with the labor intensive skills, that's a part of it. But tell us about the transition into your first purchase, and then what that looked like, and just take us through your journey.
Yeah, definitely. So, real estate is one of my passions. Like I said, grew up into it, but there were a lot of things that I didn't really like. I was a property manager, I was a leasing agent, I was a handyman, I was pretty much doing it all, and I always hated, those random calls during the night. Just get a lot of anxiety, and I just, asked myself, there has to be a better way to do this, right? Explored property management companies, and um, at this scale, it just doesn't really make sense. So, I started looking down other avenues, came across a couple videos, dove in a little bit more into bigger pockets, and that's where I pretty much just started just learning the commercial space, and how different it was, and it pretty much solved what it was that I was looking for. I can own the real estate. I can help people invest, right? Financial literacy is a huge thing for me, especially growing up where I did and not having to lift the hammer.
Yeah, yeah, absolutely, 100%. So tell us about getting into your first deal. So you've done property management. You've done all of the key things. Those are the pillars to being successful. You just knowing every attribute to managing the real estate. Tell us about um, going beyond your family's real estate, and getting into your own.
Yeah, definitely. So right now, I will say that in multifamily, something that's very important is the teams. I started off trying to do it myself. Started putting myself out there more, connecting with people, building partnerships, and connected with a great group down in Dallas Fort Worth. So that's where we have the property right now under contract, set to close in a couple weeks. It is a 506B deal, but super excited about it. When I talk to some of my investors and just anyone else that's also investing in this deal, super excited about the returns there. So mainly, I attribute that to, obviously, you need to do your due diligence when you're partnering up with people. You need to understand how this game is played and understand the commercial standpoint. It just differs so much from the residential side, right? But it just partnerships. So that's what I'm going to hone in on. It's just building those partnerships.
Yeah, and partners in multifamily can come in a lot of different facets. Whether they're just signing on the debt for the loan, whether they're doing the due diligence, they're doing the asset management, or they're bringing in capital in the deal as a capital raiser, and then partaking in the weekly calls, monthly calls, however that's structured. So you've got a 506B, 100 plus unit in Texas. That's you all are closing on. Tell us about how you found the deal, how you've got it under contract, and then what kind of debt you all are looking at, and just the dynamics of it.
Yeah, definitely. So the team is already established down there. They have approximately 12,000 doors down there, and this deal was actually marketed earlier in the year. I believe it fell out of contract numerous times. So one of the partners received a call and they said, "Hey, we know that you can close. We've closed with you before. How do you feel about this property?" And it just kind of came onto us, fell on our lap, but it was just that relationship with the broker. Fast forwarding to that, there is a new property management that is actually managing a couple of the assets that we have down there. Um, they brought themselves up to speed. They understand the market itself. They manage the property across the street. Um, the difference in rents is about, I want to say, 200, 300 smaller floor plans, and they're at 98% occupied. So feel confident that they can come in, boost occupancy, and ultimately be able to deliver on the projections, right, on the returns.
So was this property listed on the MLS or not? Not even- just one of the major platforms or a pocket listing?
Yeah, yeah. So it was through the brokerage.
Okay. All right. Got it. You all underwrote it. You found a good delta that you feel like you can add value to, um, and here you are. What about debt? Or are you all doing agency, doing bridge? What does that look like?
Yeah, this is going to be agency. It is at 92% occupied right now, and we're coming in at 65 LTV for it. So still finalizing some of the details, but it's looking like we're going to get 5 year IO on it.
Okay, that's good. That's good. The agency debt's definitely looking good. The 10-year Treasury is coming down significantly since even last month. What's your all's capital raise look like?
So we're setting the close on that, but total is about 7 million, includes some of the capex. So about 400 on exterior, 400 on interior. We do have some reserves for the roof, and also attend to that whenever it is truly needed. So it does require a little bit of love, but there's no leakage. There's nothing. You know,
Yeah,
there's no issues right now. We just want to be prepared.
yeah, 800,000 super light for a 100 plus unit complex. What was that total? Let me see. It's total number. I think I seen it when I was going through. Yeah, 133 unit.
Yeah,
It's so it's just putting some lipstick on it and increasing the
yeah,
rents.
yeah, definitely. So the seller right now, he did a lot of the renovation and um, doing the due diligence. I mean, it's in great condition, right? Just going in here and just getting them to the platinum level. The main reason for selling is that their rate cap is expiring, so they need to get out of the deal and return some of the capital back to their investors.
Yeah, yeah, that's definitely been the ongoing saga with real estate. Well, with bridge loans in general, that and mezzanine, just everything in general with floating interest rates. So when you all are going into a property to do the inspections, what all do you look for, and how do you go about inspections?
Yeah, so we have the great team down in Dallas. Uh, They have about 50 years of construction experience. One of our partners also owns their own concrete business, so they just have a vast experience of construction. They're the ones that are going to asset manage it. They brought in a couple different contractors as well. Get some quotes on some of the like the roofing, for example, and just ensure that everything pretty much looks good, right? So we want to turn over every stone, and just ensure that we're not walking into something that's a trap, and ultimately kill the deal, right? So we want to be able to pretty much uncover any issues during that due diligence period.
Yeah, what do you all say to some to people that might be concerned with Texas and Dallas being oversaturated with new builds and units coming online?
Yeah, so that's a great question. I will say that there is some concern to have, right? But we also need to take a look at the year built, right? So this one I believe is a 69, kind of C-ish property. uh, B minus in a B area. So what we need to take a look at is we need to take a look at those properties that were just delivered a couple years ago, especially in the 2010s, right? Um, and we need to compare that to, let's say, for example, another market, Austin. About 70% of uh, those properties there were built in the 90s. So that's why it's getting built. That's why it's getting hit so hard because when you have the new construction coming in, renters take a look at that and they want to see, hey, what's the best bang for my buck, right? So our area of focus is C properties, being able to go in there and do some renovation on that, get it up to market. So from an underwriting standpoint, we also need to be conservative. We're not forecasting aggressive rent growth. We want to come in right under market because we do expect some of those rents kind of come in to come down a little bit. But when we take a look at the pipeline, I mean, we're looking at I mean, we're practically in 2024, right? 2024, we have some coming online in 2025, and then we just it's just clear water going forward. We're not seeing the amount of new construction being built in 2026, 2027. So I think, and from what we're projecting is going to take off, but from underwriting standpoint, we want to make sure that we're coming in very conservative.
I think I read a report the other day. There's like 74,000 units expected to be delivered within the next 12 months. Like, holy cow! That's
Yeah,
which I mean, population is growing, but there's a certain niche that I think is protected. And that's workforce housing, and that's C class properties in C class areas. And the reason is because ultimately subsidies are offered on those properties, and when you have subsidies offered, that brings in your clientele and workforce housing that's prone. The new vintage assets, um, they're all they're all more than anything market rate tenants. So not having the subsidies be offered, you kind of have a protected niche of tenant base. Um, and whether it just churns from one complex to the other, but at the same time, you're not truly affected by all of the institutional product that's coming online. Now, I think that there's going to be a lot more supply than demand for a given time. Because it's what developers do. They build, build, build. The cycle changes. They stop building, and then all of a sudden there's no new supply coming online for a certain period of time, and they build, 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 and they stop it again. So it's history keeps on repeating itself, and that's with anywhere. If you follow history, it just rhymes. It's not the same. It just rhymes. But massive amount of product is coming online. We focus on workforce housing as well. Tougher to manage. You've got a lot of nuances. Properties are typically older vintage, 1970s into 80s. Um, but you're offering subsidies. You've got maybe 30% subsidy, and then you've got 70 or even 40% that are market rate. But um, how are you all? What are you all looking for? What's your buy box? How do you pick out the ones you want versus the ones you don't want when you're looking for properties?
yeah, definitely. So, I mean, the first thing is going to be location. We want to be in those prime locations or at least close to them or where we believe that it's in the path of progress, right? We take a look at the medium household income. We want to make sure that we're in an area where we feel comfortable that renters can pay their rent. And then when we take a look at the asset, we take a look at anything from 60 up to comfortably 150 that we can take on ourselves. And it's really going to depend on what the state of the asset is, right? So we can go as far back as like mid 60s, 70s, but just understanding, hey, does it have aluminum wiring, right? Um, does it have cast iron? Are there any leaks? It just those we're just gonna have to take additional precautions for that. But essentially, if we can come into a newer build right at the right price, 60 to about 150 or so doors. Pitched roofs are preferred. I say everyone's kind of looking for that, and then just kind of updated plumbing and
Yeah.
electrical.
I think the chiller systems were a major issue in a
Yeah,
few years ago when you guys had a massive freeze. But and that was something that wasn't on the radar, but then all of a sudden it was on the radar. What are your all's insurance costs looking like per unit per year?
So we're looking at about I want to say anywhere from 800 to 12.
Okay.
We kind of run it through a couple different brokers, and it's not about what's the best price. It's about what's the best coverage, right? So there's a lot of properties that we've seen that um, have experienced fires. There's just a lot of things kind of going on. So we just want to make sure that we're protected, and that if anything were to happen, we can go in there, have no issues with insurance, and be able to rebuild.
Got it. Yeah. Yeah. Well, and that's there's lenders that are requiring the insurance policy to be replacement value,
Hmm.
which is way more than what the actual debt is on a property. I think that's where some of the issues are coming from with these inflated insurance bills. Just depends on, of course, lender specifics, but um, say it states an $8 million property and the debt on it is called 4 million. Instead of having a policy for 4 million to pay the debt off, they want it for the replacement value, which again, it's lender specific. You just got to make sure that that's in your underwriting and in your accounting for it, because that is a huge cost. And then taxes going up, taxes that are readjusting currently throughout the markets. That's something that a lot of operators have not considered or taken into their underwriting, which is creating again more ripples. What are you seeing out in the market right now with operators and just in general?
Yeah, I mean, I think a lot of operators are just trying to make it work, and they're trying to show those returns that are gonna, capture those investors, right? When we took a look at property taxes for this specific asset, obviously we put a buffer on there, right? Um, and come to find out that the millage rate actually decreased, so we're about to save about 30,000 annually on that. So that's just gonna boost. Um, our returns there. But I think is, obviously coming in from a conservative standpoint, um, we don't know where the market is going to go next, right? I think we can all anticipate, but it's just we want to account for the worst case scenario.
Yeah, yeah, for sure. Well, have it all in the underwriting, but then where are the interest rates going? I think the Fed has signaled reductions, but ING, they've got a forecast of 150 basis point reduction next year, and then UBS came out with another report of 250 basis points. So
Yeah,
there's definitely we just don't know what the black swan event is just quite yet. Got an election year, so we know that's happening.
yeah.
Um,
And I think we're a lot of us are banking on that, and I think we just need to wait and see.
Yeah, I mean, in agency, you're still able to achieve within the fives, which I think is
Hmm.
is absolute fives and six. It can underwrite and still be comfortable debt, for sure. I think it's more of the bridge debt. You've got renovations you've got on a property, and you've got a shorter time horizon on your business plan. The bridge debt was a very useful tool as long as it's structured right and got, of course, rate caps or locked rate, but um, that's obviously getting some people in trouble. What kind of deal flow are you all seeing?
Yeah, so it's a little light right now. I would say we get a couple deals in every week. We're taking a look at a portfolio right now, 104 and 108 in Fort Worth. But we just want to stay disciplined in the specific locations where we think that we're setting ourselves up for success. Obviously, fitting the buy box as far as the asset. So right now, it's just really honing in on the operations, the order of pretty much our process, and then just strengthening a lot of the relationships that we have with the brokers. So it's a little light, but I think that just allows us more time to establish that relationship.
Yeah, it's I know here in the Midwest, we're out of Cincinnati. It's picking up. Pocket listings are picking up. Deals are being sent over. I don't think that there's not enough emphasis on the need to sell just yet with some of these deals, as far as seller sentiment softening up. but it's getting there. It's totally different than where these deals were penciling in at from last year. So we're definitely excited for what's up and coming. It's going to be tough for some, but it's an opportunity for others, and opportunity we've been preparing ourselves for. We bought very conservatively through the last let's call it 3 years. So what we've got in front of us could be good. Um, so when it
Congratulations on the
comes,
new headquarters, by the way.
yeah, that's going to be a great property. We've got crews there right now, so it's exciting seeing it come together. So it's definitely things are always in motion and changing. So it's just flipping open new chapters. So
Yeah,
I appreciate that.
yeah, of
Um,
course.
what about investors coming in on the deals? Are you seeing tougher to raise capital, or are you switching gears to different types of equity structures? What does that look like?
Yeah, so I think everyone would say it's a lot tougher now. And what we kind of find out is um, in a lot of the properties that pretty much failed, right? And those operators had to turn back the keys. We're just picking up on what happened, what went wrong, and honestly, a lot of these investors are also picking up on that. So when we spoke about floating rate debt, um, that's a lot. That's a big no-no from what we're seeing from a lot of investors. So obviously, um, we want to come in with the fixed rate. We want to make sure that we're conservative. We have that transparency in case anyone's very technical and wants to understand the numbers. And it's just building the relationship. Um, I'd say, last year, right, 2021, everyone was just kind of throwing money around, and now it's like, how much can I keep, right? I think it's just human instinct to not think about how much you can gain, but how much can you stop yourself from losing. So it is a little tougher, but I think we're doing a great job of putting ourselves out there, going to different conferences. We were just at the Grant Cardone event this past weekend, and just truly understanding what people are looking for, and coming with the mindset of how can I help you, how can I be of service to you, opposed to,
Yeah.
hey, I got this deal, give us your money.
Well, let's talk about that. What was the general census of the event? 'Cause Grant Cardone is, of course, very well known. So, what, as far as being there, getting any action, what are they saying? What kind of market see in the market?
Yeah, they're buying. They're aggressively buying. So I think Grant Cardone only closed one or two deals this year. But during the presentation, he's pulling up all these, A class, 800, 1,000 unit properties, and talking about his process, flying out to different cities. I was kind of surprised that he talked a lot about Chicago, but I mean the assets that he's looking down here are overseeing Grant Park. It's great location, so they're aggressively, from what it seems like, aggressively looking and trying to buy.
Yeah, I seen the put a post out there for a man. I think it was 500 some units on in Chicago. That he was basically a skyscraper. But I'm surprised
Yeah,
I mean, Chicago's a great city, but at the same time, Chicago's got issues, um,
yeah.
tenant
And I'm
issues.
I'm from Chicago, so I see those issues every day.
Yeah.
And even from the smaller residential side, because we still have a couple properties here on residential, like we're trying to exit those. I think Chicago itself will still be there. It's a huge city. I don't think it'll go away, but it just has its problems.
Yeah. Well, you've got people moving out of those cities and states and heading into more favorable states that have more favorable laws. But
Hmm.
yeah, it's going to be interesting to see. Um, very cool. What's in the future? What's on your horizon?
Yeah, it's that what what we're focusing on right now is still getting that continuous deal flow, strengthening relationships with brokers, with investors, and just continuing on, right? So I think right now, where we are in the cycle, there's going to be a huge transfer of wealth. We're starting to see big institutions, putting a lot of their assets up for sale or exiting, right? I think right now is the perfect time to get in. But I think that there's still a lot of caution to have. We just need to come in conservative, and we need to pick kind of like those no brainers, right? We can get in at the right price and make sense. Then let's go, fast forward on those. So it's just continuing to strengthen those relationships, continuing to add more to the portfolio. So I mean, we're all in right now, and on Dallas, there's going to be a little bit of turbulence, but I think that once we navigate through what's coming, right? I think it's going to be is going to set us up for success.
Yeah, yep. That's what it's about: is scalability and being able to leverage. And you all utilize third-party property management.
Yes.
Okay. Yeah, that's going to be a big part in our plans here in the next 24 months, and then go back and then bring the properties into our portfolio under our management. But in order to scale, you have to leverage in any caliber that you can. So we're putting a huge emphasis on the next 24 months. So third party property management is a part of the plan, but long term, you've got to it's you have to have control of the property's performance. It is when you put it in someone else's lap, it's going to be controlled to their expectations, and their
Yeah.
expectations are never your expectations. So
Yeah.
we've learned that. Very cool. If somebody wants to reach out to you, get more information, possibly invest with you, see what you're doing, how can they reach out?
Yeah, definitely. So I'm on Facebook, Eddie Esparza, also on Instagram, Eddie_Esparza1, and then on TikTok, Epic Property Ventures.
Awesome. Very cool. Eddie, we definitely appreciate you coming on the show. I look forward to following you, and we will certainly talk soon.